Deal making is dormant. The pandemic has cut activity in half, leaving a lot of cash with no place to go. And Leslie Picker joins us now on that story. Leslie.
Hey, Andrew, it's an interesting problem to have, right? Deal making had been picking up, but now with the resurgence of coronavirus across much of the United States, many would-be sellers are going back into hibernation mode. U.S. deal volumes so far this year have plummeted more than 60% from 2019 levels, and several deals signed last year fell apart before they were even completed. Now, the recent spike in virus cases is causing a backdrop of high uncertainty, creating headwinds to do large buyouts in more traditional industries, says John Gray. He is the president of Blackstone, which has an industry record $156 billion in dry powder to invest.
We've shown a willingness to deploy capital, even into the most impacted areas. But there tends to be a little more resistance to that as people want to sell into a little bit of a healthier market.
In addition to greater resistance from sellers, the pandemic is making it harder for deal makers to conduct negotiations and due diligence without physically being in the right place. And without a strong sense of future cash flows, finding an agreeable price is nearly impossible, guys.
Right. Leslie, here's the conundrum, and I talk to a lot of, I think, maybe similar people you do in the private equity space and elsewhere. You know, part of them think that the farther we get down this year, that things are going to get better, things will be healthier, and therefore people will be more inclined to sell to them. There's a flip side, which is you look at some of the big banks, J.P. Morgan and others, putting out big reserves with an expectation that the third, fourth quarter, and maybe even early 2021 is going to be harder. In which case, you'd think that'd be better for private equity, but also maybe harder to make a deal.
Right.
Who's going to win?
Right. Well, that's the thing. It's a good question. I mean, there is certainly an opportunity for, especially for a lot of these distressed investors, to be looking at buying companies as they go through Chapter 11 proceedings. That's one thing. That, of course, won't help the volumes for M&A because those are usually smaller deals because they're dealing with bankrupt companies. But that is the big issue right now. And if you're a big private equity firm, you're sitting on all this capital. A lot of the capital has fee holidays right after it's raised. But eventually, and for Blackstone this is the case, those fee holidays are largely over. And so they have a bunch of investors that are paying them management fees, and they're going to start to feel more pressure to put that capital to work. And it can be difficult in an environment like this.